When you go and you raise money from somebody, those are called limited partners. And then what you typically see when you look at a fund is something what they call the 2+20 model. So what that tells you is the 2%, that's the percentage of the fund that the firm's going to take as a management fee, say 2%, and then 20% is the profit of the fund that the money makes over doing deals over a period of time. Hey guys, it's Carl Allen. Got a really awesome video for you today about private equity investors, how they actually work with us on doing deals and how they actually make money for themselves and also from their investors that they put inside of their funds. And what's great about this question is it came from the chat off of one of my other videos. So if you've got a burning question or there's anything that I want to teach you that's not inside of this channel, then definitely hit me up in the comments. My team will flag that and I will do one of those videos for you. And it's been a couple of months because I've been traveling like crazy doing deals. Been a couple of months since I did one of my whiteboard videos and I know you guys love them. I've seen the Professor Carl messages inside of the group. You like it when I break things down on a whiteboard using numbers. So let's talk about private equity investors. So private equity investors are basically people that create funds using money. They go and get money from banks, pension funds, insurance companies, high net worths, university endowments, all those different things, and they put those monies into a fund. So when you set up a fund, you're called something called a GP, a general partner, and you go out and you solicit money from people, and you can create your own fund as well, even though it takes a lot of time, a lot of money, it's very complicated, but better for the first few deals that you do, go and actually use other people's funds to do your deals. So when you go and you raise money from somebody, those are called limited partners. And then what you typically see when you look at a fund is something what they call the 2+20 model. So what that tells you is the 2%, that's the percentage of the fund that the firm's going to take as a management fee, say 2%, and then 20% is the profit of the fund that the money makes over doing deals over a period of time. So let's say this fund, let's say it's called LBO fund. That's the name of the fund. It's there to do deals with us. And they go out and they raise $11 million from their limited partners. So they've got, let's say they've got 11 LPs at $1 million each. So 11 people or companies have all put $1 million into this fund. And then what happens is initially 2% of that money per year gets used for the management fee. So that would be $220,000 per year. So let's say over the life of the fund, $1 million of that money. So it's 11 million total. And then let's say $1 million of that money is spent on fees and other costs. So we're left with $10 million to invest. And then let's say the strategy of this fund is to go and do, say, 5 deals. They'll probably do more than that. So they're going to do 5 deals at a $2 million equity investment each. So 5 times 2 is 10 mil, plus the $1 million for fees. That's how the $11 million that the fund's going to raise across those 11 investors at $1 million each. That's how that money's going to go and get spent. And then let's say they go out and they do 5 deals. So we got deal 1, deal 2, deal 3, deal 4, and deal 5. And each one of those deals gets allocated $2 million. So the money going in to deal 1 is $2 million, deal 2 is $2 million, deal 3 is $2 million, deal 4 is $2 million, and deal 5 is $2 million. So all the money's now been spent, right? Now let's see what happens with these deals to see how much money the fund makes. So let's say these are all $5 million deals. So it's a $5 million deal. The PE firm's coming in, the fund's coming in for $2 million of that capital, right? So $2 million goes into deal number 1. Let's assume that's your deal and you absolutely blow that business up. And it's a $5 million deal when you buy it. And then let's say you grow that business, you do some bolt-on acquisitions, and then you exit that for say $50 million. So $50 million was the selling price. So the PE that's put the money in, they've just made 10 times their money, right? Which is a great return for a fund. So $2 million has gone in. $20 million has come out because they've got a 10x return on that investment, right? So deal number 1, brilliant. Let's say deal number 2 did okay, didn't do amazingly well, but didn't do badly. So deal number 2, they put 2 million in and they got 5 million out, right? So it was a 2.5x, okay? 2.5x return. Deal 3, let's say they put 2 million in, nothing really happened with that business, but it sold for $5 million. So their 2 million came in and $2 million came out. So they basically just got their money back, right? So no return on that investment. They put 2 million in, they got 2 million back. Obviously, with the cost of capital over time, inflation, there's been some value erosion on that. But for the sake of this math, let's just leave it at that. And then let's say deal 4 and deal 5, those businesses failed. The money went in, the businesses either went bankrupt or run out of cash or whatever they did. So 0 money came out of those deals. So they have no returns either. So we've done 5 deals, only 2 of them have actually made money. 1 returned the capital that was put in, and 2 actually lost money. So if we tally this up, right? If we tally this up, so 2 million went in, 20 million came out. So the profit on deal 1 was 18 million bucks. Absolutely fantastic. On deal 2, 2 million went in, 5 million came out. So that made a $3 million profit. Great. Deal 3 made no profit at all. And then deal 4 actually lost money, lost 2 million. And deal 5 actually lost 2 million, couldn't get the money back. So if you add all that up, so we've got 18 plus 3 is 21, less 4 million. So the net profit across that fund was $17 million, right? 10 million went in, 20 plus 5 plus 2, 27 came out. So that's a $17 million profit. So now what happens is, it's an 80-20 split. The fund's on 20% profit. So the $17 million of profit that was made, so the GP, the fund, is going to get 20% of that, which is $3.4 million, right? And then the limited partners, they get the rest, which would be 13.6 million. So that's the profitability split. And then what's interesting is the fund is they've made $17 million profit. So $10 million went in, $27 million came out. So the fund has made a 2.7x cash on cash return, right? And if you did an internal rate of return on that, which is the KPI, the metric, the score that all funds use, let's say that was over a 5-year period, 2.7x cash on cash over 5 years is actually a 22% internal rate of return. And that's kind of the minimum, really. That's the minimum level of performance. Anything over 20, you're going to be able to go out and probably raise more capital. If you were driving 50% internal rates of return, and you could prove that when you're going out and you're raising more money for the next fund, you're going to be inundated with investors wanting you to manage their money for them. So that's how private equity funds work. They're on a 2 plus 20 model typically. 2% management fee, 20% share of profits. They go and get capital from limited partners. They cover their fees. They invest the rest of the money over a bunch of different deals. Typically in a fund, one deal will absolutely blow up and pay for all the failures. One will do okay or make the money back, and then the rest typically will fail. So I hope you found that useful. Definitely hit me up with any more questions or any more videos that you want me to do. And then please hit like and subscribe to this channel so you're getting all of my content in real time the second that I'm putting it out there into the world. So I hope you got some value from that. I will see you guys soon on the next video. Until then, bye for now.
Hey guys, I'm Carl Allen. I'm the founder of Dealmaker Wealth Society. I've done tens of billions of dollars of deals over the last 30 plus years. If you're new to my channel, definitely hit like and subscribe so that you can get all of my amazing Dealmaker content in real time. You're not going to miss any of the outstanding information that I'm going to share with you. And if there's a question that you've got, if there's something that you want to know the answer for and you want me to speak to it, definitely hit me up in the comments section and I will record those videos for you and I will get them on this channel as soon as possible. So love having you part of this YouTube community and I can't wait to serve you. Until then, bye-bye for now.